Hello, everyone, and thank you so much for joining us for week 3 of BFSG's 4-part fall webinar series. This week discussing taxes. I think everybody's, probably either most or least favorite topic out in the world. I think our two panelists today, Paul Horn from BFSG and Cecilia from Redwitz, will try to make it fun and engaging for all of you. With that, let me hand it over to our two panelists, Mr. Paul Horn.
All right. Thanks, everyone, for joining us today. Again, my name is Paul Horn. I'm the Director of Financial Planning for Benefit BFSG. The other's kind of a mouthful. I apologize if I have any coughs today. I'm just getting over cold myself. We have a very lucky to have Cecilia join us today. She's an esteemed colleague. Cecilia, go ahead and introduce yourself.
Hi, thank you, Paul, and hello, everybody. My name is Cecilia Patterson. I am a CPA with Redwitz Inc. I'm a tax director here, and thank you, Paul and Chad, for inviting me. I'm really happy to be here.
Perfect. All right, so Chad, let's start with our first poll.
I don't actually have that in Zoom, but let's just ask it and let people type it in the chat box. If you pull up that chat box of yours, when do you normally do tax planning? Do you file when you file your taxes after the new year, before year end, or why should I even be doing tax planning? If you pull up that chat box and send it in, I will start reading them off as they come in and we'll get a good idea. We already got some B's, we got some A's, we got some C's. I don't see a D yet, which I love.
I don't see a D either.
That is awesome. we have a really good group of attendees this year. You'll see it over time, but I even got it all year long, by the way, which is I think probably Paul and Cecilia's favorite answer we've seen.
Yes, it is.
Yes.
Always. There we go.
I finally got a D, by the way. So that person is good to be on this webinar. With that, let me get back. So I mean, we got a very good scattering of A, B's, and C's. We do have a D in there, so I think that person's definitely looking for some of your guidance today. And again, all year long, I think this goes to me and Paul talk about a lot. If you do it when you file taxes, you're just filing taxes. That's not tax planning, quote unquote, right? That's just doing taxes. And I think part of the discussion that we're going to have today is tax planning. It's why we do this in November, so you can think about these things prior to year end when you can still make some changes to your tax situation.
Correct.
Right.
Yeah, most levers you have to adjust your taxes have to be done by calendar year end. So that's why we want to have you talking with a financial planner or CPA, ideally sometime late October to end of November. Gives you and the CPA time to review things, make any adjustments, and then implement any strategies that might make sense.
Yeah, I actually just recently had a client who wants to meet 3 or 4 times a year to go through tax planning. So I'm like, if that's what you want, that's what I'm going to do.
Perfect. All right, so let's talk about some important dates before year end. Right now, we are in Medicare open enrollment. It started October 15th. It goes through December 7th. So if you are enrolled in Medicare and you want to make any changes, this is your chance to do so. There is a lot of changes coming down the pike with Medicare. Some plans are being removed. Pricing is changing on a lot of plans. So if you don't normally review your Medicare, this might be a good time to do so. If that's something you're looking at. Before December 31st, like I said, this is when most of the levers need to be pulled. So some of the more common sort of strategies that we see are called QCDs, Qualified Charitable Distributions. We'll explain what that is later. Any charitable donations, Roth conversions, net unrealized appreciation transactions, maxing up your retirement plans with your employer. Anything like that needs to be done by year end. So when we talk about the strategies today, they really are going to be broken down into 4 different buckets. The first one we'll be talking about is going to be investment portfolios and what you can do there and how that impacts your taxes. We'll take a look at things regarding retirement planning, income taxes, and then finally we're going to look at charitable and legacy planning as well. As a financial planner, I get to talk about everybody's 2 favorite things in life, death and taxes. And with taxes, it touches every aspect of every decision we make for any clients. There's always a tax implication. And so that always has to be considered.
Correct. Yeah, it's a very important aspect of it, and yeah, being a CPA, tax and and death. So,
So first, let's talk about investment portfolio strategies. The first thing to realize here is with your investments, any investment that's inside a taxable account. So that's going to be an account just in the name of the trust, or an account in your name or you and your spouse's name. Any income that's paid from that, whether it's a dividend or interest, is going to be taxable each year. Any gains on any investment that you sell over the course of that year is going to be subject to taxes. Now, when we look at the taxes, there is a benefit there called long-term capital gains and qualified dividends. And you want to try and take advantage of these as long as you can. For an investment to qualify for long-term capital gains, that means that you have to hold the investment for 12 months. So if you buy an investment on January 1st of this year, you need to hold it until January 2nd of next year to be safe. And that gives you 12-month holding period. And when you do that, any gains that you have on that investment will be taxed at long-term capital gains rates instead of short-term capital gains rates. Short-term capital gains rates are just taxed at your ordinary income tax brackets. For most people, that's going to be 22% or above. But if you're able to have it as long-term capital gains, instead that could potentially be as low as 0%, but you get a lower tax rate on that. So like I said, the first thing is we want to hold the investments for about 12 months before you sell it, if possible, to lock in the better tax rates. And then we need to look at, depending on whether you're single or married, what your income tax bracket is going to be. If it's your income tax bracket is in the 10 or 12% bracket, you actually pay zero taxes on your long-term capital gains. If you're single from 48,000 to 200,000, you're at 15%. Married, you go up to 250,000. From there, what happens is we have what's called NIIT, net investment income tax of 3.8% kicks in. This is that Obamacare surtax. And so then you go from 15 to 18.8 or 23.8. But even at 23.8, this is still a lot lower than the 35 or 37% you'd be paying if it was taxed as ordinary income. So
and the net investment income tax, the 3.8%, in doing planning, in looking at where you are now, you can see if you can get down to one of those lower rates. So it's very possible, but again, it just depends on what your income sources are and what your overall household needs are for the year. But again, planning ahead, you could possibly get to one of the lower rates and or maybe get under the net investment income tax of 3.8%.
that's a great point. And we do a lot of that planning for our clients that we're working with now, where we'll do some tax prep between now, just trying to project where they're going to be year end to make sure there's proper withholding, things like that. But one of the things that we're looking at as we're getting at the end of the year here is, are there any opportunities for things like tax loss harvesting, which is where you sell investments at a loss, locking in those losses, which can offset those gains? Or are there other things that can be done to lower your taxes, like maybe deferring some of that income with a traditional 401k or something like that to put you in that lower tax bracket? So when we're computing gains and losses, it can be a little overwhelming at first, because first what we need to do is break down the two types, right? We talked about the short-term and the long-term capital gains. Again, short-term is any investment that you held for 12 months or less when you sold it. Long-term, anything that's 12 months or more, then you get the long-term capital gains. So what you're going to first do is take all the gains and all the losses that are short-term. You're going to add all those up together and get a number. And then you're going to do the same thing with all the long-term. You're going to add all those up and then get a number. And then from there, you're going to compare the short-term and the long-term capital gains. If both of them have gains, let's say you have 3,000 in short-term capital gains, 5,000 in long-term capital gains, then just each one of those gains is going to be taxed at their respective tax rate, ordinary income tax rates or long-term capital gains tax rates. If there's one loss and one gain, Let's say you have 5,000 positive long-term gains, but 2,000 negative short-term gains. Then what you're going to do is net those, which is going to give you a net 3,000 long-term gain. That's just 5,000 minus the 2,000, right? And then you're just going to pay the income taxes on that 3,000 in that example, sorry. And if there's more losses than gains, let's say you have a $10,000 loss and a $5,000 gain, so the net is a $5,000 loss, then what happens is you can write off 3,000 of that against your income, and then the remaining amount in this example would be 2,000 gets carried forward to next year's taxes, so you don't lose that loss. It's just used to offset future capital gains. And then if there are both losses, same thing applies there.
Mr. Paul, before you move on, we have a question. I think it applies to this slide and the last slide. Can you clarify the definition, quote unquote, of investments for this? I think this gets to, a lot of people have a lot of different types of assets. And when you're thinking capital gains and losses, what types of assets or investments does this apply to?
That is an excellent question. So in general, for most individuals, I'd say 80% or more, this is just stocks, bonds, and mutual funds, ETFs. Your traditional investments you're going to have with Vanguard, Schwab, Fidelity, Robinhood, whoever you're keeping your investment accounts with. However, this can apply to virtually any investment. If you have a real estate investment trust, if you have crypto, if you have other sorts of alternative investments or hedge funds, those would also apply to this calculation.
Yeah, and if you also have, say, a flow-through entity that you're invested in, but you're not actively participating in, you're not involved in the management or the day-to-day. I know a lot of clients that maybe, a friend said, hey, let's invest in this. So yeah, we do, but you don't really actively participate. That is also subject to these rules. If they sell any items within that entity and it flows through to you individually, it's still subject to these types of limitations. The capital loss limitation of $3,000, and it will also go into the netting process.
Awesome. Yeah, amazing question. Thanks, you too.
This time of year is another good time to rebalance portfolios. And rebalancing is where you go back in and you sell some investments and you reinvest them into, essentially what you're doing is you're selling today's winners and putting them into today's losers. So the old adage we all know is buy low, sell high, right? That's what we want to do. We want to buy the investment when it's cheap. We want to sell it when it's near that all-time high. Unfortunately, for a lot of us with human nature, it's difficult to do so. So one way to help deal with that and remove the emotional impulse in investment decisions is rebalancing the portfolio. This should realistically be done at least once per year. And let's just go through an example here. This is kind of an extreme case, but we have it this way to help illustrate the point, okay? But what we're looking here is the portfolio in January 2008. What we can see here when we look at this total portfolio, it's about 70% bonds. Sorry, 70% stocks and 30% bonds. So this is what would be a 70-30 portfolio, 70% stocks, 30% bonds. This is someone that's moderately aggressive. Well, over the course of 2008, we can see the different performance levels. Stocks were all down as high as 40%, and fixed income did a whopping 5% positive. So what happens at end of the year is the portfolio becomes overweight. All of a sudden, the fixed income, which was 30% of the portfolio, becomes 42% of the portfolio. So the portfolio becomes more conservative in this example than you may be aiming for. So what we do is we sell 12% of the fixed income and we reinvest that back into the stock portfolio. And we do the same things on the other ones to try and help them get back to that kind of model allocation. The reason we do this is for two things. One is, like I said, this just helps us sell today's winners, buy tomorrow's losers to help give us the best chance for portfolio growth. But secondly, what it does is helps deal with a thing called portfolio drift, where if you're not doing this on a regular basis, your portfolio is going to become more aggressive or more conservative than you want it to be. And in a volatile market like we're in right now, you may be taking too much risk and you may be opening yourself up for a larger loss if there's a downturn in the market, or you might be missing out if you're too conservative where you should be more aggressive. So just doing this rebalancing once per year helps keep the portfolio in line. And it helps, like I said, kind of keep the emotions out of it. This is just a thing that should be done once per year on any portfolio.
Yeah. This is a great example too, Paul, because I think, if you're 40% bonds, January 2009, you felt really good about that 2 months later. But the market bottomed, for all of you that remember the global financial crisis in March of 2009. So moving that 12% back to stocks by the end of 2009 was a really smart decision because the market went on a 12-year bull market from that point on. So again, just the benefits of rebalancing. Usually you end up in like 40, like, an extra 12% stocks and you got to sell them out, put it back to fixed income. But that also goes back to risk tolerance. If you think back to global financial crisis, could your portfolio have withstood 40% losses? And if you had been doing what Paul's suggesting right here, rebalancing, it would not have seen a 40% drop in portfolio value, period. It would have saw like 20% at the max. So
Correct.
great example, Paul.
Okay, so when we talk about rebalanced portfolios, again, this is going to help take into things like tax loss harvesting, where we want to lock in some of those losses to help offset those gains to lower your taxable income or taxable capital gains. Helps create a disciplined approach. It's going to help encourage you to buy low and sell high. When we do rebalancing, we just need to be aware of a couple things here. One is understand the taxes that we are creating, because when we sell those winners, we are locking in those gains and we are creating taxes when we do that. So we want to keep that in mind. Of course, be aware of any trading costs. For most people today, this is very negligible. The other concern is what's called a wash sale. So when we sell a investment at a loss, we can't just go back and buy it the very next day. So if I sell Coke because it's down 10%, I can't go and buy Coke the next day. I have to wait 30 days. If I don't wait 30 days to rebuy that same position, then the IRS says that you're just trying to lock in the losses and that's not legal. So they're going to reverse that or treat it as though you never locked in those losses. So instead, what you would want to do is sell Coke and go buy Pepsi, sell Coke and go buy a broad index ETF, or buy something that's going to be similar to what you're selling, but not the exact same thing. So there are some rules around that. Just be careful of the wash sale rules.
Do you know any securities where that might not apply? The reason I mentioned that, because as much as we don't like to talk crypto, I like crypto. And it does not apply to cryptocurrencies. Crypto is treated as a real asset. Like you could sell Bitcoin today and buy it back a minute later, and there is no wash sale rules. So like if you want to recognize losses on some of your crypto assets or gains, it's as much as making the transaction and buying it back or selling it back, and there's no wash sale. Is there any other assets that are similar to that?
Not that I can think of.
Not that I can think of either.
Well, and before you guys leave rebalancing, because we have a good question, can you talk about like what if you have a financial advisor, or maybe you're in a target date on the 401k, 403b, 457? I mean, do you have to think about rebalancing, or
So
probably doing
if you're in a target, so number one, in a retirement account, there's no tax implications because it's tax deferred or tax free, but you still want to rebalance the portfolio. The idea of it still stands. If you have a age-based or a target date fund, they're going to rebalance that for you. That's not something you have to worry about. But if you chose your own mutual funds, or you have a 401k that you're managing on your own or whatever, it would be good then to go back in and manually do this once per year.
Yeah, and I think whether you're on a platform like Schwab or Fidelity, Empower, JP Morgan, any of the big banks and investment accounts, you do have to turn on rebalancing. Those accounts don't auto rebalance for you. You need to make sure that you check that box for the portfolio to rebalance. Same thing as you get dividends, and do you reinvest those dividends or not reinvest those dividends? You have to say yes to do that. So if you've turned on rebalancing, it will happen automatically. Just double check to make sure you turn that on.
All right, so we're going to move on to some income tax strategies.
All right, so we did the poll in the beginning and everybody had a different timing on planning. But as like Paul said, as we get to the year end, it's a good time to kind of look over what's happened during the year. Did you get married? Did you get divorced? And one thing that I found couples that I know are divorced, but they have a child dependent agreement. Like you get your child every other year. And when that happens, there's a special form in 8332 that says the actual physical custody of the child, the other parent is allowed to take that dependent. So I've had that come up a couple of times, and without the divorce decree, I don't know that. So it's good to let your accountant know. Did you have a child? Was there a death or self-employed? Did you start your own business? Did you lose your job? One thing that came up this year, which I thought was very interesting, I had a client come to me and say, "Hey, he started doing day trading. He made over $1 million of income, ordinary income. He took that money and invested it someone he saw on social media, and this is actually in the news. I had to look it up, but he took the winnings and he put them in this investment that was considered fraudulent. So he did lose everything. And so the money he had, the tax he had to pay on the winnings, he no longer had. So he came to us. And so then we had to look at different strategies like, could we be able to use this? So different events like that, which you may not think, oh, anything like that, it's a good time to talk to your accountant or financial planner to help you kind of plan for those things. Then do I have
All right, so this one again, so this one for everyone, definitely feel free to drop it in the chat box, but I am going to launch the poll too so we can share results at the end of it. But for deductions, do you normally use the standard deduction or itemized deduction? And responses are, I don't even know what this means, or I know it's standard, or I know it's itemized, or whatever somebody like Cecilia, my tax preparer, tells me to do. That's what I do, by the way. My brother's a CPA too, and it's like, what should I do? And you tell me and my wife, and we're just going to do whatever he says. So we have them coming in the polls. I think we got so far about 60% of people are saying standard deduction, about 30% saying itemized, a handful saying whatever my accountant tells me to do, and a handful out there saying I have no idea what this means. So definitely a good webinar to be on, because I think Paul and Cecilia are going to talk through some of that right now as well. All right, let me close this thing out. I will put it up on the screen for you all, but I'll give it back to you guys. I'll take that down in just a few moments.
Okay, so summary based on the one big beautiful bill. The changes, no changes in medical expenses. Again, you have to exceed 7.5% of your total income to get $1 of deduction. The state and local taxes, SALT deduction, we'll go into more detail about that. But yes, that did change, and that may make a difference between whether you itemize and take the standard deduction. The mortgage interest deduction, no changes, but again, since the JCTA, it is mortgage liability, it's limited to 750,000, so that's still in effect. Disaster and personal casualty loss, no changes. Gambling losses, that did change. And miscellaneous itemized deductions did not change. The interesting thing about gambling losses, which I've had several clients over the years who have been, like the ponies or go to Vegas or Morongo. The difference, the change is under the one big beautiful bill is that you are now limited to 10% of your gambling losses. Now, that doesn't mean that you're always going to have income. In the case where, say, you had gambling winnings of, $100,000 and you had gambling losses of $110,000, let's just say $10,000 is your limit, you would then have gambling winnings of 100,000 and gambling losses of 100,000 after that 10% shave off. So again, the thing, and kind of my background, I was a IRS agent. That's how I started my career. So I've gone through audits like this. So again, the biggest thing you have to remember is you have to have documentation. Now your CPA may not need it all, but you should keep it all. So those are the current changes, and we'll go into some of the SALT deduction in more detail in the next slide or next few slides.
I know we're going to reference that acronym quite a bit. So, the OBBA, for all of you that say, oh, she said the one big beautiful bill. Depending on the news channel that you reference, they might be calling it the one big ugly bill too. So Fox is BBB and every other channel is like BUB. So it's the same exact bill, depending on your political preferences.
That is true. That is true. So part of that, the whatever bill you want to call it, the standard deduction has gone up. So for a single person, your standard deduction is $15,750. Married filing joint, it went up from, I believe it was 30,000, and then it might have gone up to 3150 because of the one big beautiful bill. And the same with head of household and married filing separately. One of the other components of the OBBBA is that if you are over 65, you now get an additional, what they're calling like an additional standard deduction. It is a total adjustment from total income. And for a married person, it's $1,600 per person. For a single married filing joint, it's $2,000. It does phase out. So for a single person, if your AGI is between 75,000 and 175, it phases out by, I believe it's 6 cents. So, and what that means basically is once your total income goes above the 75,000, you're going to lose a little bit of that $6,000 or the $1,600 or the $2,000. And if you're married filing joint, the limitation starts at 150. By the time you hit 250,000, you've completely phased out of that additional deduction. Just so you can kind of have that kind of clear in your mind. Oh no, yeah, it is 6,000. I'm sorry. The additional deduction for 65 and older is 1,600 and then 2,000. So your standard deduction could be much higher. And also that's why when we go back to the question, do you itemize or do you take standard deduction? Since the JCTA, the standard deduction got much higher, and we no longer have personal exemption. So that was also taken into effect. So a lot of times, if at one point you were itemizing, you're probably better off taking the standard deduction. And with these additional adjustments, it's probably, it still may be favorable to take the standard deduction. I always tell clients, if you have an active mortgage, that is usually the main thing that pushes you over, where itemizing is probably the best thing to do. And again, you get the greater of the two. So that's something to look at. Also, under itemized deductions, medical expenses, I think I said earlier, anything over 7.5% of your total income, you will be able to take one additional, you can take a dollar deduction.
Quick example on that. Let's say you have 20 grand in medical expenses, and this would include dental. But let's say you have 20 grand in expenses and you make 100,000 for the year. Then you just take 7.5% of that 100,000, which is 7,500. You subtract that from the 20 grand. That leaves you 12,500. That would be allowed as a itemized deduction, just so you kind of understand how the medical expenses work there.
Hey, don't leave this page yet. I'm going to do a couple definitions, and I got somebody has a good question for you that is relevant to this slide. But I think we define it on the next page. But in case any of you are wondering, every time they say salt, that's not like salt and pepper that you're going to put on food. That is the state and local taxes. Every time that one of these two say AGI, that is adjusted gross income. And every time they say anything like the TCJA, that is the Tax Cut and Jobs Act that made taxes relatively favorable overall, although at some point probably expires. So I think we have a lot of acronyms in our industry, including BFSG, which is our company name. So just to define some of that for everybody out there. Let me get
Thank you, Chad.
The question here is, so is this 65 years old at any time in 2025 in order to be eligible for the additional deduction?
Correct.
Correct.
And does this include medical premiums?
On the medical expense? Yes.
I get continue. Thank you.
So the salt cap, the state and local tax, it was $10,000. Now it has been increased to 40,000. So that may be another advantage where it may take you from standard to itemizing. So as Chad said, it is the salt and local tax deduction. So what that means is it's your state withholding that on your payroll or your estimated tax payments that you pay to the state of California. It is also your property taxes, your personal property taxes, and then any personal property tax such as your DMV fee and like maybe if you have a boat or a trailer, those types of items as well. That all counts in under the state and local tax deduction. Now it went from 10,000 to 40,000, but there is again a income limit. So if you are single or married and your total income is 500,000 or less, you can take up to 40% or $40,000 of tax deduction for your state and local tax. If it is more, it is reduced. Again, there's a limitation and you start phasing out. But if you get to the point where you phase out of the 40,000, you'll always still be allowed the $10,000 minimum. So this example here, John and Lisa are married and have a $50,000 SALT deduction. Their modified AGI is $550,000. So the limit is 500,000. We have the $40,000 maximum that they could take. 55,000 minus 550,000 minus 500,000 times the 30% equals 25. So they are allowed a $25,000 state and local tax deduction. So it is reduced by the 25, I'm sorry, by the $25,000. So 40, no, that's right. So it's 25,000, sorry.
Yeah, so I mean, in this example here, just it's to show you how quickly it eats into that itemized deduction. If you're even 50 grand over, instead of getting a 40 grand write-off, you get a 25 grand write-off. And I think it's by 600,000, it's totally phased out.
600,000, yeah, it's totally phased out. So yeah, again, another reason for planning is to see how you can keep your income under that amount.
Wait, before you move on, because I know we have a couple slides that are specific to California, even though there's a lot of people nationwide that definitely use it as an example because other states it does apply. But I think the big thing here, summarize standard versus itemized under TCJA and where we are today. Are we paying more or less in taxes?
Most individuals are paying less taxes than they were. So let's take a step back. The TCJA, Tax Cut and Jobs Act, that was done under Trump's first term. Most individuals ended up paying lower taxes as a result of that. And then now we have the big, beautiful bill, we'll call it BBB, has new changes. And what we're seeing in general, and again, this is general, not applies to everyone. Everybody's situation is different. But what we're seeing when we're doing year-end tax planning is most individuals are seeing a reduction of about 3 to 10% in the taxes that they're paying compared to what they paid last year, assuming everything else is equal. So with the higher deductions, especially for those that are seniors, over the 65, getting that additional $6,000 senior credit is going a long way and helping reduce most individuals' taxes that they're probably going to have to pay.
Yep, I love it. And does any of the stuff you've talked about changed if you have I think a couple where somebody's more over 65 and somebody's under 65?
No, so it doesn't change things, but it just all it changes is on the standard deduction, how this works. Because like if you're married, it's $1,600 per person. So if someone is 67 and blind, they would get a $3,200 deduction. 1,600 for being over 65, 1,600 for being blind. But if you've got a spouse that's 67, another spouse that's 57, well, then you're just going to get the additional 1,600 because you just have the one that's over the 65 in that example.
Awesome.
And then the $6,000 would just be for the one spouse that was over 65,000 or 65.
Yep.
Yeah. Any other questions?
That's it so far. I got some more in the queue, but some of them can wait till the end. I got
Okay.
some already got somebody's giving me advice to give to all the attendees too, by the way. I love our group.
So one of the other things, this is more, it's a state law, a state tax planning item in California. And I'll start with California because we're based here in California, but it does affect, I believe there's 36 states in the country that follow a very similar law. We have in California, we have what is called the pass-through elective entity tax, which we like to refer to as PEAT, PTE, or PTE. How it works. If you are a business owner and you have either an S Corp or an LLC that functions, a multi-member LLC, this does not apply to a single member LLC. A partnership with you would obviously have to have multiple partners. So those three entities, if you have the flow through income coming from your business before the original law was you could have that entity pay your state tax. In California, it's 9.3%. So what would happen is your business would pay the 9.3 based on your personal taxable income. And you could, if you have multiple partners, you can elect out of it or not. You can do it or not. And so you'd figure out your state taxable income coming from the pass-through entity, multiply that by 9.3%. That is going to be the entity's deduction, state tax deduction. The entity pays it. It shows as an expense. It reduces your federal taxable income. Doesn't affect California because you can't deduct your California tax for California's tax purposes. But what that does do, once the company pays that 9.3% on your state taxable income, it then becomes a credit, almost like an estimated tax payment to the shareholder that makes the selection. Now, between 2022 and 2025, in order to qualify for this deduction, you had to make the lesser of $1,000 payment or 50% of the prior year if you made the election to take the PEAT. So if you didn't make it by June 15th, and I have clients that they just didn't understand why they should make this payment in June 15th. Again, goes back to the planning. Like if you made it in June 15th, you are able to take the deduction for that year. And so what happens now, or what has happened since Governor Newsom extended that bill, it was supposed to expire in 2025, along with the SALT limitation at the federal level. But since the SALT limitation has only gone up, it's still there. This law has been extended. It has been extended beginning in 2026, and I believe it goes through 12/31/30. The main difference is you no longer have to make that June 15th payment to qualify. So if you do tax planning now, look and see where you are, it can make a big difference at the federal level. It becomes a federal tax deduction and it becomes a personal tax credit for you. And I've got an example here to go through just so you could kind of see for, business owners. Because even though the SALT limitation went up, it still may be a good deduction for you and another planning item. So we go to the next slide. Do I have?
No, there we go.
Okay. So with this example, let's just say the pass-through income is 500,000. That is the first line. And we have the first column is without the PEAT, and this is based on a $10,000 limit. So it's the tax law as it was, and if you're unable to take an additional $30,000 deduction. So let's just say you're in the highest California tax rate. So that's 13.3%. That's $66,500. So let's just say, okay, if this is your income, on this particular income, you're going to be taxed on the $500,000. And again, this is without the PEAT payment. So let's just say you're limited $10,000. You have a $10,000 SALT deduction. The $490,000 would be your taxable income, federal taxable income. Say you're in the highest federal tax rate of 37%. You're going to owe tax of $181,300. California, again, makes no difference. you still pay tax on the 500,000, but that, and then the 66,000 is your tax. So your total cash paid is 247,800. Now with the PEAT, again, with a $10,000 limit, your entity pays the tax, but pays it at 9.3. So you're only getting a $46,500 deduction. That reduces your federal taxable income from your pass-through to 453,500. Now, if you're in California, the $10,000 limit, that could be your property taxes, that could be other state taxes. So you're still going to get that 10,000. So, but your total federal taxable income is 443,500. Your tax is 164,095. So now we go down to California again. You have to add back that deduction. So your California taxable income is still 500,000. Your tax is still 66,000, but you get a credit for the amount your entity paid of 46,500. So you only have to pay the difference between the 9.3 and the 13.3, which is 20,000. So total taxes paid out of pocket would be 184,095 versus without the PEAT, 247,800. Your federal tax saving is 17,205. Your out of pocket, not taking into account taking distributions from the entity, would be about $63,000. So that could be a huge savings. And if your total income is over 500,000, even if it's $10,000, that is a huge deduction, and that's something you should be planning for. Again, if for 2025, if you didn't make the payment in June 15th, you're not allowed to take it. But coming in 2026, you can make that payment in June. If you don't make that payment in June, it just reduces the credit that you're allowed, but you could still opt to take it. And just really quick, with the $40,000 limit, same idea, same scenario, but now you get a $40,000 tax deduction without the PEAT because the limit went up. You have 170,200 of federal tax. With the PEAT, you're down to 152. Again, same for California, it doesn't make a difference, but you get a credit with the PEAT, you don't get a credit. The net cash outlay is 236,700 versus 172,995. This is good because it kind of shows you the savings is the same. So one way I look at it is to think a quick calculation. What is your state taxable income? Multiply that by 9.3 and then multiply that by your marginal tax rate. That should give you the amount of tax you will save by making the PEAT versus not making the PEAT. I hope that all made sense.
I think it does. I can tell you, probably, sir, some of our people come from like, Arizona or Texas or Florida. They're just laughing at us like, California, your taxes. But I would mentally note at the bottom of this slide in red font, 36 states. It's not just California. I think California it's easy example. You want to call it. We all have different tax rates. So we got to pick one state. And we know a lot of people here are coming from California too. But 36 states all have some form of this. So you definitely want to talk to your accountant, depending where you live, to see if you're impacted and see how you might benefit.
Absolutely.
And then again, keeping it with the closely held business owners, the home office deduction, and since COVID and working from home, you can let your tax accountant know what the area you've been working in. If you're storing inventory in your garage, that counts as well. So keep that in mind, and you can take personal expenses such as property taxes, mortgage, repairs, utilities, things like that. New equipment. So with the OBBBA, the bonus depreciation was actually slated to go down to, I believe, 40% in 2025, has now been bumped up to 100%. And I believe the 100% was made permanent. So for bonus depreciation, if you buy a vehicle or a piece of equipment and it's over 6,000 pounds, that would be subject to 100% bonus. So for example, I had a client just email me, I'm looking to buy this car. I go online, I check the gross vehicle weight. It was over 7,000 pounds. I'm like, yep, he's going to buy that before year end. The one thing I want to say about this is that because it is November the 12th, if you buy it, it's got to be placed in service. So if you need to order something, this is the time to start looking at what you need. Retirement plan contributions, not only for as an employee, but as an employer, you want to start looking at the cash availability and looking at what getting ready to start to do the retirement plan contribution and maximizing those. Charitable contributions, again, the same, whatever, if there's specific organizations you want to apply to or donate to, that's a good way to reduce your taxes. And in starting a retirement plan, or you get a 5,000 credit for business owners starting a retirement plan. And really, I think Paula, maybe Chad know more about this. Like if you don't have one now, start talking to your advisor to get that set up. The worst thing is to have them do it quickly at the end of the year. Deferred revenue and accelerated expenses. Again, if it from a tax perspective, you're either tax or accrual. As an individual, you're you're either cash or accrual. As an individual, you're cash. So if your business is on the accrual basis, you might want to look and see how that is affecting you. It may be that maybe you need to be on the cash. I do have a really good example of this. Last year, a client, he has a business, he's on the cash basis, but he had huge accruals. He had huge AR, and so he was paying tax on the cash he received, but he hadn't received a lot of the money. So that caused a problem for him. So we looked at it and we did do a change in accounting method. It saved him probably about $50,000 to $60,000. But again, this is where you need to talk to your accountant, because once you make that change, you can't make another change for 5 years. So this isn't something that you can like, oh, okay, I'll do it this year and then I'll do it next year. No, it's a once every 5 years, and it does cost extra money to do that planning and to do that preparation. The QBID, qualified business income deduction, again, if you're a flow through, it's 20% of your taxable income from the flow through, or 20% of your modified total income. So that is a huge, especially as a flow through. If you're a single member LLC, you would qualify for that. But there are also times when, if you're a single member LLC, you may want to convert to an S Corp. Again, there are different rules, but you might get a better result from that. Again, talk to your CPA, look at the planning. And then also the Corporate Transparency Act. I think that's in limbo now, but also a good thing just to ask about it when you meet with your accountant.
Yeah, I would say this. If you're a business owner right now, it's a really, really good time just to review how your business tax situation and how that's impacting you, whether you should be set up as a flow through or C Corp. There's advantages to both. And I know a lot of clients are kind of looking at both and seeing how they're going to benefit most, whether it's from the PTE or the QBI or whatever the case is. Just so many different changes for business owners. It is now a good time to just review all this with your CPA and make sure you're doing the best thing for you and your business.
I do see really quick a question about an LLC with two managing partners that are married.
Yeah.
So that is, if you're filing as a single member LLC, the PEAT payment does not qualify for a single member LLC. But if you are filing as a multi-member LLC, similar to a partnership, you would qualify. So again, as a married couple, you could opt to file as a multi-member LLC, which is similar to a partnership. But again, that's an additional filing. And you'd have to talk to your accountant about how you hold the stock in that, or the stock, or you can convert the LLC to Corp and elect S Corp status as well.
So while you're there, I know we're getting close to the top of the hour too. So I'm going to put some survey stuff in the chat in just a minute. But you have a question right along those lines too. For sole proprietors, at what income level is it best for them to start thinking about, LLC versus S corp?
So if you're a Schedule C and you just become a LLC, if you're 100% owner of that LLC, you are a single member LLC, and there's really no difference on the tax return because as a single member LLC, you're disregarded for federal purposes, so you file a Schedule C. When I would recommend converting to an S corp is when your income gets to the point that maybe the PEAT payment would be beneficial because again, you can't take a PTE payment for a single member LLC. And also the amount of activity you're having in that Schedule C, kind of going back to my auditor days, large Schedule Cs have a greater percentage of being audited. Now, with the IRS, the way it is, maybe that's not a concern, but if you've got if you've got a Schedule C that has 10 million in gross receipts, I would say be a S corp. And
Also,
then, and then,
Looking,
oh, go ahead.
okay, I was just gonna say, one of the reasons we want to do tax planning by year end is just to make sure that you've withheld enough so there's no tax surprises next April. Nothing worse than thinking that you're good and you find out you owe the IRS $8,000. So it's good to do the planning now for that. And one of the things that we want to do is make sure you have proper withholding. You just either want to make sure you've paid 100% of last year's tax liability, which is 110% if your AGI is over 150, or at least 90% of your estimated taxes for the current year. So if last year you owe 10 grand and this year you're estimated to owe 8 grand, at least pay 90% of that 8 grand to avoid any penalties. And becomes a bigger thing for those that retire in 2025, where you're used to withholding that money from your paycheck. Now you need to start making those estimated quarterly payments or have that withholding when you're taking money out of retirement accounts or things like that. When we look at taxes, we've talked a lot about federal, but state is something to consider, which is why we talked about things like the PTE, because in California, that tax rate can be as high as 13.3%. If you ever wanted to consider relocating, looking at the rates in those different states is something to consider. But obviously, the highest tax states like New York, Minnesota, Oregon, California, those are some of the states that are going to benefit most from things like the SALT increase from the 10,000 to 40,000. And then we've talked a little bit about this, but it's just important to manage your tax brackets. So here's some strategies to consider if your income is kind of uneven. If your income's steady year to year, it's pretty simple, but maybe you're a business owner or maybe you had kind of a windfall this year. If you're in a higher tax year where your income is higher, maybe you sold a home with capital gains or whatever the case is, you may want to increase retirement plan contributions, accelerate your charitable gifting, avoid locking in some of those things. So maybe instead of rebalancing in December, maybe you rebalance in January to avoid locking in more long-term capital gains that you're going to have to pay a higher tax rate on. You want to pull forward any losses. So really anything that's going to defer your income, you're going to want to do. And if you're in a lower tax year, this might sound counterintuitive, but you may actually want to accelerate your income recognition. So if you have things like stock options, if you want to do Roth conversions, if you want to recognize capital gains, maybe you have a spouse that was laid off and hasn't worked for 9 months. With that lower income tax for that year, it might be a good time to do other strategies that will trigger taxes at a lower tax rate than you would normally pay.
all right.
We're going to skip the poll just for sake of time.
I'm putting it up anyways because it's a fun one, but
Okay.
it's also a multi-choice too. So I think we're used to just pick one, but you might contribute to 1, 2, 3, or all of these. So definitely put it up there. Let us know what types of different accounts that you're contributing to. Hopefully all of you, especially if you're part of our institutional business, are contributing to your 401k, 403b, or 457 plan, but maybe a traditional or Roth IRA separately as well. Let me go back to you guys. I'll end poll in just a second. I'll share results, but continue on. I know we're getting close to the top of the hour.
No problem.
91%, by the way, are contributing to their employer plan. I love this group.
Great. Great to see. Cecilia, can you talk about HSAs?
Yeah. So in order to qualify for an HSA, you have to have a high deductible plan, medical plan, and that can be either as an employee or a business owner. HSA can be used to reimburse medical expenses. The maximum family contribution in 2025 is $8,550 with a catch up of $1,000 at age 55. Maximum single 2025 is $4,300, $1,000 catch up at 55. You can pay medical expenses for out of pocket or save for HSA retirement. So basically, you would just save all of your receipts. Again, it goes back to documentation. Save your receipts. You can either take the money out now or wait until later on down the road, and you can pull that out to use the money for anything. So you would have to stop contributing to your HSA up to 6 months before you enter the Medicare application. But again, with the contributions, they grow tax-free. And again, when you take them out, they're tax-free as well.
It's triple tax-free. So you get a tax deduction for making the contributions. They grow tax-free and they come out tax-free. So the money in the HSA literally never sees taxes when it's used for qualified health expenses. It is a great way to put the money aside, get that deduction now. That money can be invested in mutual funds, stocks, bonds, things like that, and grow over time. And most people will build their HSA now to cover future medical expenses, or God forbid they have a year with a high expense, then they have money to pull that from.
Yeah, so I got a couple here. So I mentioned I had a reminder from one of our attendees for all the audience. But can you talk a little bit about the difference between the HSA, health savings account, and an FSA, which is typically considered a flexible spending account because they are not the same. One can roll over forever. FSAs typically might only be able to roll over like $500. This is very timely too. I think a lot of companies are in open enrollment. I mean, I just had a client that ended open enrollment last week too. Some companies are continuing through December.
Yeah.
Can you talk about the differences between those two real quick?
Yeah. So an FSA is a flexible spending account. You get a deduction on the money going in, but it's use it or lose it. If you don't spend that money by year end, and a lot of times I see clients using that money to stock up on Band-Aids and cough syrup
And
things
sunscreen,
like
guys.
that.
I have sunscreen out the wazoo.
Yeah. And so that's what you want to use a flexible spending account for. It's good. It's got lower contribution limits, has to be spent by year end. So if you have one and you haven't used it, go find a chiropractor, go find whatever you need to get yourself better between now and year end. Just make sure that money's spent. And HSA is not use it or lose it. Like I said, that money can be invested. You can put that money in now and it could be used 20 years down the road to cover your health insurance premiums in retirement.
And there are stores, guys. I mean, you can just Google FSA store. I mean, even Amazon has a FSA like version on their website. You can just say FSA eligible and use your FSA to buy a bunch of stuff. I mean, you could buy Aura rings and like glasses, by the way. If you need new glasses, FSAs can be used to purchase glasses. So there's a lot of ways to use that balance if you still have it, so you don't lose it. Just be cognizant is FSAs are typically use it or lose it, and you can only roll over a certain amount. Can you real quick before you move on, guys, talk about like why do you need to stop contributing to your HSA 6 months before applying for Medicare?
Because Medicare said so.
Yeah.
I can't give you a straighter or easier answer than that. Once you're on Medicare, you can't contribute to a health savings account.
Yeah, it's just the rules. It's the Medicare rules.
Yeah.
So, like, know when you're planning to that's why definitely you talk to your accountant, talk to your financial planner. And if you're on top of it, that's why we say tax planning is a year-long endeavor so that you're on top of some of these things. It's not a when you file taxes type of thing. Just to make sure, like if you're about to file for Medicare, you want to stop some of these things and be cognizant.
And then looking at Roth conversions, this is a great way to help manage your assets and create additional wealth for you over your lifetime. Sorry, I have the hiccups here. What a Roth conversion is you're taking money out of a tax deferred account like a traditional IRA or a traditional 401k, and you're putting it into a Roth account. And remember, traditional is tax deferred, Roth is after tax. So what's happening is you're taking that money out of the tax deferred account, triggering the taxes on it, but then you're putting it in the Roth account. So now that money grows tax free for the rest of your life. So that future growth that you get becomes tax free, whereas it would be tax deferred or taxable when you took it out as a distribution from the tax deferred account. So these conversions are done with a lot of our clients, and we do them to help create additional wealth over time or for legacy planning. If you're trying to move money to your heirs, the most efficient way to do so is through a Roth 401k or Roth IRA. These conversions are ideally done in lower income years, or we use what's called a fill the bucket approach, where let's say, you have 15,000 left before you hit the top of your tax bracket. Let's say you're in the 22% tax bracket. You have 15 grand left before you bump up to the 24% tax bracket. Maybe you just convert like 8,000 or 10,000 at that 22% bracket, trying to just make sure you're not bumping yourself up to the next tax bracket. So we'll do that fill the bucket approach a lot. If you are close to Medicare age, so 63, 64, 65, these increase in income can impact things around your Medicare Part B and Part D premiums. It's known as IRMA. And so if you are 63 to 65, before you do a Roth conversion, just do additional planning with a financial planner or a CPA, just to make sure that you're not triggering additional costs that are not taxes, but additional premiums that you're going to have to pay that could have been avoided if you didn't do the Roth conversion potentially.
So charitable giving, again, one of the objectives you're in planning, if there are organizations you like to donate to, cash and checks, appreciated stock is a good one to donate. There are also donor advised funds that you can speak with your investment manager about opening that up. And what that does is you're able to open up a fund, make the contributions, the income can build tax-free in that account. You get the deduction when you make the contribution, but then the money can be given to charities of your choice, or discussing with the asset manager, the organizations that it can be distributed to. Again, we talked about QCDs, IRA, qualified charitable distributions. If you have an IRA and you have to take required minimum distributions, if it's a year where maybe you don't need the cash or you want to try to reduce your taxable income, you can opt to have a certain amount sent directly to an organization. And again, you would discuss that with your asset manager. Private foundations, if you have a private foundation, look to see again in the whole planning scheme what can be contributed to reduce your taxable income. Charitable trust and charitable gift annuities. Again, if you have, I think the best thing you can do into those items is donate appreciated stock. You do not have to pay tax on the gain. When you do that, you actually get a deduction at the fair market value. And depending on the type of trust, you actually get a certain amount back based on a set percentage. Was there anything that I missed on that, Paul?
The only thing I would add is the QCDs, the qualified charitable donations from the IRAs. Those are a real interesting thing that we do for a lot of clients. And we do it for two reasons. One is you can do these before your RMD starts. So most individuals, their RMD starts at either 73 to 75, depending on the year that you're born. But you can start doing these QCDs as early as the year earlier
70
as
and
the
a
year
half.
you turn
Yeah.
70 and a half, correct. So we have clients that are maybe charitably inclined that are 71. They don't have to take their RMDs yet, but they want to do charitable gifting. If you don't have cash or stock that's appreciated you want to give, doing it from the IRA using those QCDs doesn't trigger any additional taxes for you. So it's a tax neutral event. So the money comes out, you don't pay any taxes on it. and it goes to the charity tax-free, that reduces your future RMDs and that maximizes the amount of money going to the charity.
Yeah, just because we have a real life and a client example of it too. I think, a lot of people might have most of their money in their 401k or 403b, like their employer sponsored account. In most employers, not all, but in several employers, you could take a partial distribution from your retirement account, drop it into your IRA just to do a QCD, right? So even though it can't go straight from your 401k or 403b to the charity, you just take, maybe you want to give $20,000, you take $20,000 from your 401k or 403b, put it in your IRA, QCD it, and there's an ultra tax advantage there.
We have a client that we work with that has a 403b. Their plan allows for that in-plan transfer that Chad's talking about. They are very, very charitably inclined, still working, but they want to make those contributions from the IRA. But so we're doing that conversion, moving it from the 403b to the IRA, just so they can do those QCDs from the IRA.
Like the IRA is set up exclusively for charitable contributions. I mean, they'd take, 30K out of 403b, drop to IRA, and then give direction to the different charities they want to, send it to, and then do the same thing every year. So, I mean, something to be mindful of for those of you that are charitably inclined is writing a check could be very expensive from a tax perspective, and these QCDs are a really good way to maximize what you contribute.
Skip the slide there. And then the last thing here is just making annual gifts. So these annual gifts would be to friends and family members, non-charities. There is no deduction if you give money to a family or friend. You don't get to write that off on your tax return, but it can be a way to reduce your overall estate. And a lot of older individuals would rather give their money to their kids while they're living so they can see the benefits of it for their kids, instead of waiting to give all their money to their kids when they die. Now, the gift is $19,000 per person per year. So in this example here, we have a married couple and they have 3 kids. They want to give each of the kids the max possible. So what they could do is each spouse can gift each child $19,000. So 19 times 2 is 38,000. They can gift each child $38,000 this year. That would be reducing their estate by 114,000. And if you're trying to do this in really quickly, 529 for a grandchild or for a child, you can actually do 5 years worth of gifting in year 1. So if you open a 529 for a grandchild this year, you can put in all 5 years worth of contributions, and then you just can't make another contribution until year 6. But it's a way that you can accelerate gifting if that is a goal or a need.
And with the OBBBA, the estate tax exemption went up to 15 million, and they say it's permanent. Well, it's permanent as long as this administration is in the office. So just keep that in mind. Just keep that in mind. So and one of the things I had mentioned to Paul is, when you do have a death, if you're relatively, you may not have a taxable estate, but you can file an estate tax return, a 706, to maintain the unused exemption amount of your spouse. That's called portability election. And even if the administration changes and the exemption amount goes down, that portability remains. So you still get to keep that. So it's I like to call it like insurance, because we don't know what's going to happen with the next administration. But if they do drop it down, so when you hear the word permanent, it's not necessarily permanent.
Yep. I think you have one of the most important slides coming up too, but can you, for this slide, define who a gift can go to, like any individual or specifically family members?
Any individual.
Like I could send it to like one of my best friends and say, I want to gift my best friend, $38,000 between me and my spouse.
Yep.
Yep. Awesome. Thank you.
Okay. So things that you should be doing before year end should be running a standard versus itemized projection to see what's going to give you more. Like we talked about, accelerate any deductible expenses. Most individuals, their tax rates are coming down this year. And so it is a good year for a lot of individuals to lock in more long-term capital gains rates, do more of that portfolio rebalancing, since most people are having lower taxes now, and just trying to get those portfolios back in line with the risk that you're trying to take. We've talked about the business, looking at the bonus depreciation or expensing opportunities, or just reevaluating the business structure just to make sure it makes the most sense for you. Pay attention to the income phase outs. Another thing is the clean energy credit goes away end of the year. So if you have any solar panels for the home, energy efficient windows, if you want this sort of deduction for those have to be done by December 31st of this year. That credit goes away after December 31st of this year. The deduction that you get for EV car purchases, so like buying a new Tesla or a new Rivian, those have passed. The deadline for that was September 30th of this year. So if you buy a fully electronic vehicle after September 30th of this year, starting October 1st, you will not get a credit for that. We talked about revisiting the estate and gifting strategies on the last slide, and really just meet with a CPA or your financial advisor if they do tax planning, just to make sure you're taking advantage of everything that you should be doing. Just some changes that we saw from the OBBBA. There is no tax on tips up to $25,000. No tax on overtime up to $12,500. There can be a deduction on a loan, auto loan for the first $10,000 in interest paid. And then there's a charitable contribution deduction you can take for $1,000 for single files or $2,000 for joint filers. These are what are called above the line deductions, and these are great deductions to take advantage of if you qualify for any of them.
And the auto loan limit interest has an income limitation. I
It
can't remember.
does, yeah.
So it,
As you're going to learn with the rule of this is on the OBBA, there's a lot of great benefits being offered if you don't make enough money, if you don't make too much money. And looking at the pros and cons, so from the OBBA, what we're seeing is more certainty for long-term planning. So at least for the next several years, things should stabilize. It should be easier to project and predict taxes. Makes tax planning a lot easier for everyone. The higher SALT provision, which expires 2029. 2029 will be the last year at that 40,000 limit. As it stands today, starting in 2030, that SALT cap, the state and local income tax, will revert to 10,000 starting in 2030. The QBI deduction is permanent, so that's great for pass-through entities, the new deductions on tips and overs. The exemptions for the estate tax and the gift exemption is huge. As Cecilia mentioned, it's 15 million. Things that we're concerned about are things that weren't as good from it. Like we said, most of the benefits are temporary or they have phase outs. So if you're a high income earner, you're not going to get to benefit from a lot of these new deductions that have been talked about. It is still very complex. If you're a service business owner, you may be losing benefits. Like we talked about the phase outs for the high earners, the energy credits are gone at the end of this year. So if you are thinking of doing any remodeling to your home, consider doing that between now and end of the year if it's still feasible. And then we may see a reversion in future years without any sort of extension. So the one thing we know about taxes and estate planning is it's never permanent, as Cecilia mentioned. I've been doing this now for over 20 years. I've seen the tax code with major overhauls 3 times, and I think 4 times on the estate tax exemptions and the add addition of portability and all that sort of stuff. So the only thing that we know is change is the only constant when it comes to this stuff. It guarantees jobs for those that do taxes. So it is a complex issue, and just make sure you're working with a tax advisor that understands your situation and can help you personally.
Awesome. Thanks, you too. So I know I've been asking a lot of questions throughout as they came in and when we're on specific slides, but we do have a number of good questions still in the queue. The first one goes to Roth. If somebody takes money from their retirement account, right, 401k, 403b, 457, et cetera, and moves it into a Roth IRA, do they still need to wait 5 years since there's a 5-year rule on that Roth account?
So if it's the first contribution, the answer is yes. The clock starts when that Roth is opened and when that first contribution is made. So if you've had a Roth open for 9 years, there's not a 5-year limit on year 10 for that money.
Yeah, I think other way to say that is it's not a rolling clock. So I think everybody out there, if you're able and you're under that 150,000 plus or minus income limit, just open a Roth IRA. Put $1 in there just so you have it open. Because at any point in time, that 5-year clock starts at that moment you open that account. And if you drop money in there down the road or roll over from your 401k into that account, the 5-year clock expires, the moment 5 years is over. So, if you don't have a Roth IRA and you're eligible, open a Roth IRA.
Yep.
Even if it's with $1, just so that you don't have to worry about this rule at any point in the future. But yeah, if you're already retired, definitely something to talk to your accountant because you don't want to need to touch that money for 5 years from today. The next one I have, and this goes back to the 529, and it's really the super funding that you talked about. Can you catch up and pay 5 years worth of 38K each year after year one of opening 529? I think the answer to that's a no. You could do it like every 5 years, but say you drop that 150 plus $1,000 in year one, in year six, could you do another $150,000?
No, are you talking about for the 529?
Yep.
No, it's just a one time for the first 5 years.
Yeah, so the example there is you could drop, it's over $150,000 you could drop into that account in year one. You can't do it annually. And even in year six, you could just go back to dropping another $38,000.
Yeah, whatever. Yeah, correct.
Cool. Okay, so next question I have for you, this goes to portfolio risk and rebalancing that we talked about relatively early on. Is just changing the portfolio risk, right? From moderate to conservative. Is that something that should also be changed on a yearly basis, right? Is that a form of rebalancing?
No, that is called panic.
Yeah.
So the reality is this: with your investments and your risk tolerance, it's naturally going to change over time as you approach retirement, right? So think of your lifestyle in two phases. You've got your accumulation and your distribution phase. All of us that are not retired yet are still working, still growing our assets. And then when you retire, you begin to live off your assets. So in this accumulation phase, you typically want to take as much risk as you're comfortable taking, give that money the best chance for growth. But then once you retire, a lot of people do make their portfolios more conservative because now it becomes more important to protect the money than it is to grow the money. So there is a natural occurrence over time as portfolios become more conservative. That's why if you look at like a target date fund or a target retirement fund, they over time will naturally become more conservative. But that shouldn't be fluctuating year in and year out. You shouldn't be going all in 100% stocks one year because you like the president, and then the new president's in office and you freak out, so you go 100% bonds or 100% cash. That's not wise investing. You want to find a model that works for you at your risk tolerance range, and that really should be adjusted with a professional to help dial that in and a financial plan. And then that should stay pretty static. It may change a little bit. You may go from 70% stocks to 60% stocks, but you shouldn't be going from 70% stocks to 30% stocks.
Yeah, and I mean, I'd add to that. It's easy. Just reach out. We have risk tolerance questionnaires that can help you dial in. It's knowing your risk preferences, right? Like if you know when the whole world collapses that you're going to stay invested, like global financial crisis and COVID-19, markets down 30, 40%. That was honestly the worst time to get out, right? Because every paycheck in your retirement account, you're contributing the same dollar amount and you're now buying stocks cheaper. And in both cases, the market rallied insanely in the next couple of years. So definitely don't want to panic. It's one of those though, if you would have sold all of your stocks at 20%, like if you had just had a 70% stock portfolio, you wouldn't have gone down 40% in the first place, right? So filling out that risk tolerance questionnaire to know your level of risk is one of the most important things. It shouldn't change every year, but definitely reevaluate with life changes, right? Like maybe you get married It's no longer your risk tolerance. It's you and your spouse's risk tolerance together. Maybe you have a child, and I love going to Vegas and throwing dice on the craps table, but that's gambling money, right? And I know I'm probably going to lose all of it. I'm very risky in that regard, but in my 401k, that's going to pay for me and my family and my spouse. I'm way more conservative because that is our life, right? Like down the road. And I can't just risk that all on the craps table in Vegas. So it's knowing your risk tolerance. And as life changes, you buy a house or you need a car and things like that, big changes, maybe your risk tolerance does change over time as it's no longer you, but now your family that you're thinking about. The next one I have for you all, and this just came in actually too, is when you think about starting a Roth, is there an income limit?
There is.
Yes and no.
Yep. I love that. Go.
Here's what I mean by that. A Roth IRA stands for individual retirement account. There is a income limit for that. For the Roth IRA, I believe it's around 137,000 for single and like 160 for married. Don't hold me to those numbers. We'd have to look them up exactly, which is what I'm trying to do. There we go. But
I don't think this has
way
the
around. Sorry, go ahead.
I don't think this has the phase out threshold. It just has the
You're right. You're right. It doesn't have the yeah.
But so yeah, it's called phase out. So in an IRA or individual
right here.
account, there you go. Yep, that you could. So in a Roth IRA that you can open up at any bank, right? Schwab, Fidelity, JP Morgan, Wells Fargo, B of A, whatever. Individual retirement account, there is a phase out. Basically, if you make too much money, you cannot save in a Roth IRA. The government doesn't want to give you the tax-free earnings over time. There's a big myth out there because so many people are familiar with the IRA rules that if you make that much money, you just can't save in a Roth. Well, your employer-sponsored account, be it 401k, 403b, or 457 plan, does not have a phase-out threshold. So you can make $25 million and still save in your employer-sponsored 401k, 403b, 457 account in the Roth bucket. It's just called a Roth 401k or Roth 403b, whatever it is, right? It's one account, pre-tax and Roth money all goes to the same place. Your record keeper that your employer-sponsored plan is with will account for it, right? They just have separate buckets for you. But it's a big piece of confusion. People are used to, I make $200,000, I can't save in a Roth. Doesn't matter in your 401k account. You can contribute Roth inside of your employer-sponsored plan.
Correct.
Yeah, great question there. So next one I have is, we're going back to HSAs, or actually let me do the Roth IRA one first. If doing a backdoor Roth IRA, so think after tax funds,
yep,
and converting it, are other funds and IRAs, like, pre-tax funds considered in determining how much is taxable for that backdoor conversion?
Yes, it is. So if you're doing what's called a backdoor Roth contribution, that's where your income is above these income limits. So let's say you make 350,000 and you still want to contribute. Technically, you can using a backdoor Roth contribution. What happens is you open a IRA, the money goes into the IRA after tax, meaning you get no tax deduction, but then the money grows tax deferred, and then you immediately transfer the money from that traditional IRA into a Roth. So now the growth on that money going forward is tax free. So there is a way to do that. But if you have money in other IRAs, then what happens is there's what's called the aggregation rule from the IRS. With the aggregation rule, they're going to look at all the balances of all IRAs. So let's say you put in $7,000 and you're going to do the contribution or the switch. And then let's say you have an IRA with a $20,000 rollover balance. Well, then the IRS is going to look at that 7,000 that's for the backdoor Roth plus the 20,000 you have in that IRA. They're going to aggregate them, add them together. So that's $27,000 in total IRAs. And then they're going to take the percentage of that that's taxable. So that's just the 20,000 divided by that 27. In this example here, that's 74%. So let's just call it 75% of that $7,000 contribution is actually subject to income taxes when you do the backdoor Roth contributions. So if you have an existing IRA, before doing the backdoor Roth contributions, talk with a financial planner or CPA so you fully understand how that impacts you from a tax perspective.
Awesome. Thank you, sir. Next question. Is there a deadline and maximum for when to seek reimbursements from HSA? It's a fun question. Could somebody, have a bunch of expenses and retire and 30 years down the road, submit those receipts?
It's in the year, the distributions are made in the year that the money's needed.
It is a
Yeah.
good question, though. I would start saving every receipt that I ever made for like toothpaste from this point forward.
Yeah.
Next one. This is the last question we have right now. Actually, I think I have one more in the chat box too, but HSA question. Is it true? I have a child under 26-year-old on my qualifying HDHP who is not a dependent on 1040, that they can open HSA and fund it for the full family amount, like $8,500. Is this in addition to them funding their own HSA? It sounds too good to be true.
That I don't know about that. I haven't heard of that.
Okay, so my interpretation of this, can you guys hear me?
Yep. Hey, I can hear you.
Yeah.
Okay, sorry. My internet cut out there for a second. If you have a non-dependent who has their own, okay, so let's break this down. The mom and dad, one of them has a high deductible healthcare plan, has an HSA. They can contribute the 7,500 or up to the 8,500 limit. If they have not a dependent that has their own healthcare plan, that is a high deductible healthcare plan, then they can qualify under their own terms for an HSA, and they can make the contributions based on whether they're single or they're married. But you can't overlap the two. They're separate entities.
Yeah.
Yeah, awesome. Thank you, sir. I mean,
If you have more questions on that, feel free to reach out. I'm happy to discuss that offline.
Yeah. I'll put, can you go back to the contact us next steps? If you reach out to financialplanning@bfsu.com, and when somebody from our team can schedule some time with you as well. And then the other one is there a 12-month rule on HSA contributions? Or is it just calendar year?
I believe it's
It's
calendar
calendar
year.
Yeah, it is from January 1st to December 31st. That's where these limits apply. So, really January 2nd of next year, you can drop another, $8,000 in there. You just can't contribute the rest of the year.
Correct.
Okay, so the next question is these are coming from the chat box too. And I do have some questions about the slides. I did just post in the chat box a link to download a PDF of all the slides that we've gone through today. So for those of you asking for a question on the slides, they are in the chat box. They will also be available in the email our team sends. I think Zoom automatically will send a link to the replay. The slides will not be in the one that comes from Zoom, but our team will send one email to everybody that attended that includes a link to the slide deck as well. Next question I have those, are there any HSA issues with Social Security? I think the question says Medicare too. We know stop contributing to HSA 6 months before you apply for Medicare. Is there any considerations with Social Security though?
I don't believe so, no.
Not that I'm aware of.
Yeah, awesome. Okay, next one is, and this one goes back to some of the creative math for capital gains that we talked about very early on. But can you kind of talk through the math from, offsetting long-term capital gains and short-term capital losses and how all that netting makes sense and goes back and forth? That was early on. I can give you the slide number.
Yeah, I got it.
Back to slide 8.
So quick rundown on this again. And let's assume for the example here, we have 10,000 short-term capital gains. We have 6,000 long-term capital loss. Okay, so we've netted all them out. We've added up and added all the short-term gains and losses. We've added all the long-term gains and losses, and that's what we end up with. Okay, so we have 10,000 short-term capital gains, 6,000 long-term capital loss. So then what we have to do, because in this example, we would have one loss and one gain. So now we're in this middle blue bucket. Okay. Now what we do is we're going to net them together. We're going to take the 10,000 and the 6,000, and that's going to give us a net of 4,000 short-term capital gain, right? 10,000 short-term capital gain 6,000 long-term capital loss. So if we put those together, that creates 4,000 in short-term capital gains. Well, now that leaves 4,000 long short-term capital gains. That's going to be taxed, all 4,000 at the short-term capital gains tax rates. Now let's assume that we have a $4,000 loss short-term capital gains and a $8,000 long-term capital loss. So we have nothing but losses. They get netted together. So now that is 11,000 in total losses for the year. We're going to write off 3,000 against our income. And then we're going to carry $8,000 loss into next year that will be used to offset gains in next year's tax year. If you have more questions on this, yeah, feel free to approach me, approach one of us afterwards with your situation. We can kind of help you understand how to net it for yourself.
Cool. The next one, I have somebody whose parent passed away this year.
Sorry to hear.
So the next one I have is, these are coming from the chat box too, by the way. People just put some questions in there. This person's parent passed away. They're going to get their retirement account soon as the beneficiary. How will that be taxed?
So questions need to be answered in order to answer this question. So I'm going to give kind of a broad strokes. If the individual that passed away has a traditional IRA or traditional 401k that is subject to RMDs, the required minimum distributions that they have to take out, that money will have to be taken out this year based on that individual's life expectancy, and a tax return will have to be filed this year for the individual that is deceased. Once that is done, then the individual that's inheriting that would open up what's called an inherited IRA. And then starting next year, distributions will have to be made. RMDs will have to be taken out by the beneficiary, the one that inherited that account. And they're going to have to take money out based on their own calculations that the IRS would do for you. So Schwab or Fidelity, wherever the money's held, they will tell you how much money you're going to have to take out next year, but you're just going to have to make sure that you take that money out. That's a kind of a broad overview.
Yeah, I mean, can you just really quickly speak to, like, what if it's a Roth account? Like, if they Roth 401k, Roth 403b that somebody inherits, what's different?
Only difference there is you don't have the RMD at the individual level. So the individual that passed, there is no RMD for a Roth account.
And that's
so there's no money that
rule.
has to be taken out before the distributions are made and the inherited account is opened.
Yep. Awesome.
But if you take that full retirement account out the year of death, the beneficiary, it will all be taxable to them. So it's only if you roll it into another IRA, then you're allowed to take it out over the beneficiary's life expectancy.
Yeah, so definitely for this individual, you want to talk to your accountant and financial planner to make sure you strategize this. Otherwise, you might have a really big tax bill in year one, where you might be able to strategize it and send less money to the federal government. So we had things, somebody says, I thought we had to take it out over 10 years if they inherit.
Correct. Yeah,
that is accurate. They just didn't get all the way down to the nuances in the timing and math.
But again, that just want to make sure they understand. If they take it out all in 1 year, it's all taxable. It has to be rolled over to get the 10-year spread.
Yeah. So next one, and this is the last question as of this moment, although obviously some more might come in. Can a spouse on a high deductible medical plan deposit an HSA contribution in his or her own HSA account separate from the employer's HSA account?
No, it's just the individual that has whoever his name is on the high deductible healthcare plan. They're the individual that can contribute to the HSA.
Awesome. That's the last one I have. Any closing remarks from the two of you? Otherwise, Paul, can you put that disclosure up in the meantime too, so Mike doesn't get on us?
Got to keep compliance team happy. I have nothing else other than Cecilia. Thank you so much for taking the time and effort to do this with us today.
Paul, Chad, thank you. And yeah, again, going back to the planning, it should be done every all throughout the year.
Yeah, agreed. That's what I say. It's called tax planning is a 12-month endeavor. You never stop tax planning. If you do it on April 14th, then you definitely did not plan ahead. Awesome. Thanks, you too. Thanks everybody for attending us
Thank you.
and sticking with us
Thank
throughout
you.
the 90-minute
Thank you,
presentation.
everybody.
Thanks.
And we'll see you all soon.